Hello, I'm Russell Poynton from Edison. I'm delighted to have with us yet again the CEO of Card Factory, Darcy Willson-Rymer. Darcy, welcome back.
Thank you, Russell. Very nice to see you again.
And so you've obviously just reported your interim results. We'll talk about a number of areas within the results as we go through, but can we start on the retail side of the business? You've generally reported good revenue growth on top of a very tough comparator from last year, really. We had a strong period last year. There was good growth in cards. There was even better growth in the newer categories. So could you just give some insight into what's driving that growth?
Sure. So overall, if we just talk about our stores, we had total sales growth of 6.1% in the first half, and that's driven by a combination of new stores and driving like-for-like sales. So like-for-like sales were 3.5% in the first half, and as you said, that's over strong growth last year. And really, what we've been doing is executing our strategy. So at the Capital Markets Day, we talked about how we redefine the market, but being cards 1.5 billion, gifting is a 10 billion market, and celebration essentials. So in total, we're playing in a 13.5 billion market, and we've been still driving card growth, but disproportionately driving our gifting and celebration essentials. And we've seen some really good success as we've driven those categories. So last year we did all of the space reallocation. We've entered into new categories, so we're seeing good growth in gifting. We're seeing good growth in the party categories as well. And so overall, it's the strategy in action, and we're seeing the results off the back of that.
Okay. And you mentioned the store space reallocation refurbishment that you went through last year. Has that gone as planned? Are there things, what's gone well, what has gone less well?
So I think from a store perspective and the growth that we're seeing, actually, I think the team have done an outstanding job. And I think the work last year was probably more catch-up, where we had to reallocate. We reallocated 7% of space away from card into gift and celebration essentials. And that space translated, 7% of decreases in card space actually translated into a 16% increase in space in the other categories, just because of the way the fixtures work. Now where we are is we're continuing to grow those categories. We're continuing to innovate and bring in new products. And I would say now it's much more a business as usual, as well, whilst we're refine at every season what is the right space for each category, and even the subcategories. How much space are we allocated to the subcategories within gift or within the celebration essentials? So it's now an ongoing process. And if we look, for example, we're just about to enter the golden quarter, and we look at Christmas. I'm really excited about Christmas. We've done a lot of range development. 80% of all the products that we're putting in front of customers this year is new. And we've got newness in cards. We're putting in some really beautiful premium card ranges off the back of some new designs coming out of the studio, but also some investments in the factory. We are going to see some new ranges in To Your Pet and From Your Pet, as well as baby. So quite a bit of newness, within that.
So there was a notable increase in the rate of store openings in the first half. And it was coincidentally the same number as you had in the second half last year. So is there anything specific driving that, or is it just a matter of the way the store openings fell? As
part of our strategic plan, we said there would be 90 net new stores over the 4-year period of the life of that plan. We are probably slightly ahead of where we thought we'd be. We opened 15 net new stores in the first half, and that's off the back of 26 net new stores last year. And really the focus is in a number of areas. So number one is continuing to develop in some white space, so continuing to develop in Ireland. There's opportunities for us in central London, where we open our fourth central London store. But also there's quite a bit of infill still. But in doing so, we maintain the disciplines that Card Factory's always had and been famous for. So we have a very profitable store estate. Less than 1% of our estate is loss-making, which is probably one of the better retail estates. We continue to have flexible leases, and we target payback in under 2 years, and we're averaging about an 18-month payback, including the new stores that we open. So it's some really good progress.
Thanks, Darcy. Moving on to online. So you've now had 2 consecutive halves of revenue growth in cardfactory.co.uk. And that's after you've invested in the platforms, the customer experience. So could you just give some insight into what customers are doing online, the purchasing habits, their frequency, what they're buying, that type of thing?
Yeah, so we've continued to invest in the customer experience, and some notable things that we've done in this half of the year. We've continued to invest in both the platform and the doorstep experience in order to improve the customer experience. On the platform, we've launched an upgraded version of our event reminders to make it easy for customers to be reminded for their special celebrations. We've made some changes to the AI engine that makes suggestions to customers. We've done some development on the app where we can now do app-only promotions in order to drive people to that. And as well as customers have noticed the improvements we've made to both basket and checkout. So continuing to do that. And then in terms of the offer, so we have continued to invest in some new products with a real focus on personalization, but also on celebrations and how do we bring a whole celebrations experience. So we're still in the investment phase, some really good progress, but more work to do.
You mentioned you're in the investment phase. Now, online is still loss-making for you a little bit. So is this balance between investing to grow and profitability, isn't it? So can you just give some idea how you think about that going a bit further out?
First of all, if we start from where we have come, and when cardfactory.co.uk was first built, it was built like a big store. And what we did is we trained customers to come to cardfactory.co.uk for the products that were available in store. Where in actual fact, what we're be really clear on what each channel does. And online is really about personalization, but it's also about whole solution fulfillment. So for example, in each and every store, we might not be able to stock the whole party range, or we've launched a personalized party range, online. And so it's really about that pivot for online, and then making sure that we've got the offer exactly right, and then we know what customers we want to target, how we market to them, drive trial on the site, repeats, and then you go through the cycle. But as I said, we're still in the investment phase. We expect, to be profitable over the next couple of years.
So moving on to partnerships, there's obviously quite a lot going on in the partnership business. So could you just talk about that for a while, please?
If I take a step back, we've made some brilliant progress in the partnership business, and there were a number of key topics that we talked about in our results. So, and I think coming out of that, there's probably 2 clear messages. So first of all, we announced the expansion of our relationship with Aldi, and we're going from 550 stores to 1,200 stores, as well as, and that will be our 4th renewal with Aldi, and we're in place with our 2nd renewal with TRS in Australia. And the point of that is to say, so we've demonstrated we can win new business, but also that we can retain and grow our existing partnerships. Then in addition to that, on the new business side, we've announced a small acquisition in Ireland where we've acquired Galana Limited. And that is about completing our work in Ireland. So we've been investing in stores, and now we're beginning the investment in partnerships. The nice thing about Galana is that it is a wholesaler of cars, primarily to the convenience sector, and that's not a sector that we're in, and it's not a sector where we have expertise. So in addition to it's helping us in Ireland with the cultural differences but it also provides us with the learning on how to do convenience, which we could then potentially expand into Northern Ireland, and gives us then the knowledge to determine whether that's appropriate for the UK or not. So that was one. And then the second announcement we made was a partnership in the US, where we are going to put a Christmas range into a number of stores into the US market. Now, the significance of that is if we're going to deliver on the 80 million of new growth that we talked about at the CMD, we're going to have to crack America, given it's the largest card market in the world, 1.5 billion in the UK, it's 7 billion in the US. And so for us, that first step, dipping our toe in the water, many companies have gone abroad and not been successful. So we're excited about the learning opportunity this brings. We're gonna get Card Factory product in front of thousands of customers in the US, and we're gonna get a really good read on how our quality value offer resonates with customers in the US.
And you're going to give some more information on that in the next couple of months, I think.
Yes, as soon as it's appropriate and we're able to make the announcements, we'll basically bring that forward. So overall, really good progress. But again, as always, our work is never done.
Yeah. So moving on to profitability for the year, you've given a very clear message that your expectations are still where they were at the start of the year. And there's a few moving parts within that. Obviously, there's the typical H2 seasonality. Half two is bigger than half one, and you always have an eye on costs. We know that, but specifically in the release, you also mentioned efficiency and productivity savings. So could you just give some examples of what you mean by that?
So if you look at the profitability, effectively what has happened is that we've had inflationary costs coming into the business ahead of some of the results of some of the initiatives. So from my perspective, this is a timing issue. Look, in an ideal world, what you do is you line up all of your initiatives that they line up and land in order to cover inflation. And given all of the work we've been doing, whether that be the things we've talked about, opening new stores, product development, getting ready to launch in the US. And so what we'll see in the second half of the year is some of those productivity initiatives come through. But the reasons to believe, so in half two, in order for us to deliver on our full year expectations, about 50% of the improvement in profitability is seasonality. It comes in automatically, and that's year in, year out. And the other half comes from a range of initiatives. So one, it's the full year effect of things we did in the second half of last year or the first half of this year. There's the range development that we've done for Christmas as we have expanded some of our more premium lines. And then we have a series of initiatives around efficiency that will basically deliver the rest. The other thing that's really important is all of the components to deliver the efficiency, whether it's the systems on labor management, whatever it is, all of the things have been implemented. They're in store or in the factory or in the warehouse already there. So we're not dependent on future activity. We're dependent on our execution of the things that we've put in place, of which we're in control of. And so that's what gives us that's what gives us the confidence to reiterate our guidance of hitting our full year numbers.
That's great. That's very clear. Thank you very much. And finally, the dividend. You reinstated the final dividend with the full year results. You declared an interim dividend, which is good. So there's a lot of confidence in the business, I suspect.
Yeah, so at the end of last year, we announced both a combination of the interim and final dividend together. We were unable to do an interim dividend last year, given we still had some of the COVID loans still outstanding. That's now being cleared. I think also we were very clear in our results announcement, the prelims, of our capital allocation policy and the four critical components of maintaining a strong balance sheet, having sufficient cash to invest in the strategy and the future growth of the business, reinstatement of the dividend, and then keep all options on the table for any excess cash, with the principle that we don't want to hold on to shareholders' money that we don't have, that we can generate superior returns on. And so, yeah, we're pleased to announce that dividend. It applies a 3 times cover, for the full year, and we're committed to a progressive dividend and cash returns for our shareholders.
Darcy, so there's a lot going on, obviously, which is good to hear. So, any final words for the viewers?
Yeah, look, I think, Russell, we're making really good progress on our transformation to becoming a celebrations destination for our customers, serving more customers in more places, whether that's through our stores, the work we're doing online, or with our partnerships.
Darcy, thanks for spending some time with us today, and we look forward to seeing the results next year.
Thanks very much, and look forward to seeing you next time.
Thank you.